Joining us today is Henry Dachowitz, who is an expert in accounting, finance, and business. He is also Chief Financial Officer of an internet retailer, a Harvard MBA, and has decades of experience in business. Henry, it's a real pleasure to have you here with us today. We maybe get started off by having you just tell us a little bit about your background so our listeners can have some context around your expertise in accounting, finance, and business?
Sure, I'd be glad to. I started off with a college degree in accounting, and I joined the old Coopers & Lybrand, now PricewaterhouseCoopers, as an auditor. I then got my MBA at Harvard Business School, and I have worked as an executive in business for over 30 years. I've been a management consultant with what's currently Deloitte Consulting. I was a vice president and controller, as well as an internal management consultant with Bankers Trust. I was an equity research analyst with Sanford Bernstein. I've been CFO of 3 high-tech companies, including one biotech, which I took public. I was treasurer of Nassau County in New York, where we had a $2.4 billion annual budget, and I was in charge of $3 billion of debt. We got 11 bond rating increases in a 3-year period. And for the last 6 years, I've been an independent financial consultant, where I work primarily with entrepreneurs, putting together business plans, raising money, and initiating the growth of the company.
Wonderful. Well, today I think what would be really very interesting for our listeners would be to really delve into your expertise in financial accounting and maybe look at it also a little bit from an investor's standpoint. So, maybe we can just get it started by asking you, if you are an investor or for any investment professional, how would you rank the 3 major statements, the income statement, balance sheet, and cash flow statement, in terms of their importance when really evaluating the value, the worth of a business?
I would give it 40-40-20, 40 to the P&L, 40 to the balance sheet, 20 to cash flow. I think the most important thing is looking at future profitability of a company. So I look at the P&L. I want to understand the revenue growth, how the costs increase over time, and what's happening to gross profit and net income bottom line. Is that expanding and widening? The balance sheet is important to look at in conjunction, because you could have things going on there with your working capital that affect you. Are the receivables getting out of proportion to your sales? What are your payables? Are you getting cheap financing from your vendors? How is your inventory? Is it turning? Might you have a risk of inventory obsolescence down the road? What's the equity section look like? How have you financed yourselves? Is it long-term debt? Is it stockholders' equity? Do you have an overhang of options and warrants that might dilute equity holders? The cash flow statement sort of is a check to make sure that your accrual basis profitability is not based on non-cash resources. The cash has to come through, and you want to make sure that from an accrual basis, your cash flow statement shows similar indications of profitability. If your accrual income is increasing, but your cash is not increasing, that begs the question, how are you making your profits? Is it based on accruals and deferrals?
And I think that's part of the reason why a lot of more value-oriented investors rank the cash flow statement quite highly, because they always want to get to the so-called free cash flow number. Could you just explain a little bit how free cash flow relates to net income and what you like to see in terms of how the two relate to each other?
Well, free cash flow is a basis where you're looking at the operating income. your income from operations before financing activities and before investing activities, and says how much cash is being generated by the purchasing and sale of goods and services, which is your major core business activity. Now, when I look at investments, for example, in property, plant, and equipment, you often have a proxy that says your depreciation might be equivalent to the amount of cash necessary for new investment. So that might be a wash. If you're growing, I can understand why you need greater investments. But your operations should be the key generation of cash. If your cash generation is from raising funds by capital activities, then there's a concern about your core profitability. And so the free cash flow should be a mirror of what's going on an accrual basis. But there's a reason why we have accrual basis accounting. You may have a sale that you haven't gotten paid for yet, or you bought something that you didn't pay for. Accrual basis gives you those numbers, whereas cash basis may show you misleading numbers. So I look at the two in conjunction with one another.
Now, obviously, when it comes to accruals, management does have some latitude and in terms of using their judgment and estimates. Can you give us a few examples of some of the line items where you feel like there's the most judgment involved, or where managements really can, play with the numbers a little bit if they wanted to? What are some of those income statement items where that's a possibility?
Okay, the first would be with accounts receivable and allowance for bad debts. Company often makes an estimate of how many of those receivables will not be collectible. They might underestimate the amount of receivables that they will not collect. So this year's income statement looks better, and then in the future, when they have larger write-offs, it's just a one-time thing. So it should be based on reality patterns of how much they're collecting. The second might be inventory. So you have inventory cost flow assumptions, and you have to make sure there's some consistency there. You also have to have an estimate of obsolescence of inventory. If you have millions of dollars of inventory and your competitor comes out with a new version of the product, your inventory might be worth half overnight. So you have to be aware of how much is invested in inventory and what is the risk of obsolescence. You might have reserves. So, for example, in an insurance company, you have reserves based on future claims. Insurance companies might underestimate the amount of reserve for future claims, which is a current expense, and therefore they inflate the current income. Down the road, when they have the claims and they don't have enough reserves, they take a bigger hit. But that would be a way they might inflate current earnings.
And now, when you talk about some of the estimates around cost of goods, and I think you raise a really good point, which is the inventory obsolescence, and it seems like a lot of analysts tend to then look at inventory write-offs as a one-time charge and essentially try to ignore them. Would you take those into account and maybe apply them historically to say, to get to a more appropriate level of reserving?
I think the best yardstick is industry by industry. So, for example, if you have a high-tech industry, okay, Barnes & Noble is selling a Nook, Amazon is selling a Kindle, okay, a new innovation can come out and wipe out the value of a whole generation of inventory. Same thing with iPods and Nokia phones. If, on the other hand, your product is in an industry that's not as fast moving, then the life cycle, I'll give you an example of copying machines. 50 years ago, copiers were the high-tech items that with new innovations might get obsolete quickly. I think now the pace of innovation of copying equipment is much lower, I would worry less about that obsolescence. So I think the first guideline is what's going on in the industry. The second is looking at historical records of who is the pioneer. There are certain companies within industries that are at the what we call the bleeding edge. They come out with the newest, latest, and greatest, and they may either have a big hit or they may have something that doesn't catch on. The followers are the ones where you might have to worry about the obsolescence. So the question is, what are the inventory turns? Okay, you look at the amount of inventory that's on hand and you compare it to the annual cost of goods sold. How many times does that inventory turn? If they're turning their inventory reasonably quickly, I don't worry about obsolescence. They should be able to sell their inventory and move to new goods. But if they turn their inventory only twice a year, that means they've got 6 months on hand. That might go bad if someone comes out with a revolutionary new product.
Now, you also mentioned insurance company reserves, and I think for some insurance companies that have kind of long-term obligations, it becomes really hard for investors to gauge whether a company is reserving properly because those claims may not be evident for many years. So how would you go about assessing it in such a scenario?
In that case, I would again look at the individual types of lines of insurance that they're writing and what are their peers in the industry group doing. So for example, right now, there are new policies coming out called cyber liability. This is the liability of information, let's say credit card and personal information of customers. When those get breached, you could have very large losses. A good example is TJ Maxx years ago. So these are new types of insurance policies, and they're feeling their way around. They set premiums, they have deductibles, but when there's a large loss, are those premiums sufficient to cover everyone? So those are harder to judge, and the only way you can check is to see how big a book of business they have and compare their criteria, the premiums, as well as their capacity and their deductibles compared to the industry norm. I think on other policies that might have a long tail, like medical malpractice, there are well-established databases because they've been out there for tens of years where you could find out, here's what the reserves look like, here's what the claims look like over an extended period of time, and their reserves are reasonable compared to their peer group.
And to what extent would you say it's also legitimate to look at the historical track record of an insurance company and say, you know, this management team has been doing this for a couple of decades, let's say, and historically, when you look at the revisions to reserves, it hasn't been an issue. So would you also view that as a legitimate exercise to say, while we can't really ascertain what they're doing today, we are comfortable because they have a track record?
Absolutely. I think if you looked at AIG while Ace Greenberg was running them, anyone would say they were excellently managed. In fact, one might argue that in the very good years, they decreased the amount of income that they showed. They socked away money into their reserves, call it a rainy day fund, so that when they had a worse year, they had the reserves to make those earnings look flat or growing. And they were excellent managers. I think it's very appropriate to look at the management team, and if they have a history of getting hit with those so-called one-time charges of reserves because they didn't have enough, then that's something that you should bake into your analysis. You take the reported results and say, I'm going to take out a little bit more for reserves because they have a history of nasty surprises, and I'm going to decrease the amount of profitability for the current year.
And insurance companies in particular are sort of a beast of their own, if you will. They often quote line items in their earnings releases that you don't see with other types of companies. Um, would you mind just giving us a very brief overview of how you actually look at the current period profitability of a generic insurance company, or if you want to get
Sure.
specific, that would be fine.
No, that's fine. Um, Insurance companies are basically, it's a simple business with three major components. One are the premiums. How much are they charging for the risk? And then they have two types of expenses. One expense are the claims, and the other is their expense ratio. How much does it cost them to administrate the whole company? And the pure insurance experts that I'm aware of say they try to make money on premiums minus the expenses alone. The last piece is that they have all these investments. They're given proceeds up front called premiums, which they invest, and those investments throw off earnings income. So there are many insurance companies where when you deduct the claims and operating expenses, they are negative, but when you add back the investment earnings, they are positive. And that's fine. That's a model that can work. But the purists that I know try to make money even before the investment earnings. Now, just like the banks currently have real issues with the assets on their balance sheet, mortgages that may not be worthwhile, that should be written down, one always has to look at the balance sheet and the investment portfolio of an insurance company. What are they invested in? And you're looking at two things. What's the safety and security that that value will get returned? And secondly, what is the investment yield that those things are throwing off? Because that's what they're counting on to pay the claims in the future.
And the reserves that are shown on an insurance company balance sheet, are those basically a net present value of the future liability? And if so, how is that typically, what kind of interest rates do they typically use to discount?
I don't believe the reserves are a net present value. They're a current accounting entry, and that's a reserve that's available for future claims. I'm not sure they go out that far and discount it back to a net present value. What they're looking at is saying, net, how much might we have to pay out? And they're looking at the ongoing business, the book of business, the tail that we talk about. Some of those claims are going to be 30 years old. It depends also, are they a life insurance company, or are they property and casualty company? Very different types of business. Life, you have your actuarial assumptions, and you can predict with almost regularity how much the payoffs will have to be, whereas property and casualty necessarily goes up and down. You get a couple of bad hurricanes. If you haven't allocated your risk well, you might get hit poorly, or you might luck out, and if you don't get claims in one particular year, you could have good earnings, but that just might be the luck of the draw. When you're evaluating a P&C company, you really want to look at a wide span over a couple of cycles to see how well management manages over up and down cycles.
Interesting. Can we talk a little bit about EBITDA? Because that's widely used in financial analysis. Especially, I've seen it a lot with companies like cable operators or others that have large capital expenditures and a lot of depreciation amortization. Um, to what extent would you say EBITDA is a useful measure, and what are its main drawbacks?
I would say EBITDA, as you indicated, is really critical when you have high capital expenditures and your depreciation and amortization charges might mislead the numbers because cash flow generated and accrual profit might be differences. Now, like I said before, I start off with the assumption that if it was a stable company without any growth, then the amount of depreciation should be about equivalent to the amount of new investment needed to maintain the property, plant, and equipment, except for maybe inflation because prices are a little bit higher. If you have growth, then you're going to require greater investment than your depreciation. So what happens is net, it becomes a user of cash flow. So what you need to look at is EBIT before depreciation and amortization so that you could say, what is the cash flow generated by the operations? Forget about the depreciation and amortization charges and understand what the core earning power is of this enterprise. If it's growing, that EBITDA should be growing, and that's the cash that's available to finance the future growth. So it becomes very relevant. I think in a company, let's say a service industry, where there's not a lot of capital equipment and there's not heavy depreciation and amortization, EBITDA is less relevant.
And then how would we sort of take into consideration the very real capital expenditure requirements of a business like a cable company? Because if they don't spend the cash on the capex, their competitiveness probably declines over time. So would you essentially take an EBITDA and then subtract a maintenance capex to get to sort of a real pre-tax cash flow, or what's a good way to think about that?
I think you start with your EBITDA. You have your cash flow from the business. And then you can say to yourself, if we're growing the business, then we're going to require increasing amounts of capital expenditures to grow the business. What you do with a company with heavy capital expenditures, my comparison is to a retailer. As the retailer grows, they have to increase their inventory and they have to increase their accounts receivable. They have to invest in those line items. And they should do that either with capital, long-term debt, or equity, or internally generated funds. If the internally generated funds are not sufficient, then they should be increasing their capital to finance that, or else it limits their growth. Similarly, a company with heavy capital expenditures has to finance it either with long-term debt and equity or internally generated cash flow. But certainly, if I were an investor, I would project that the investment in capital, equipment, and assets is a drain on the cash flow of the business, that the investment in capital equipment is greater than the depreciation. So that should be shown in my projections, or else you're going to mislead the profitability.
Now, you talked a little bit about this, but basically there's just one line item for capital expenditures, so you both have maintenance capex and growth capex in there. And if management doesn't tell you what each is there a way for investors to actually try to estimate how much of the capex is one versus the other? Because that seems like an important data point, right?
Absolutely. I would suspect that some of that information should be in the footnotes, where if you're looking at property, plant, and equipment, they might have a breakdown of what their major investments are. Repairs and maintenance is an expense, but some of the ongoing expenditures, especially to support new growth, might be explained there. Secondly, you might look in a footnote in the capital section, debt or equity, where they might explain how they use those funds. Third, you have the cash flow statements, which should show the investment section of where those dollars are flowing. So you should be able. Fourth, you might look at the business segment information. So if you have multiple divisions, they might show a modified balance sheet by division, or the amount of capital assets employed in each division. And if you compare it year to year, you might get a flavor of where they're investing and where they are reducing the investment.
And just to get back to EBITDA real quick, Could you just explain why EBITDA is not very relevant for financial firms like banks? Why is it not used at all there?
Well, again, a bank, a professional services firm like an accounting firm, consulting firm, law firm, you don't have the heavy capital expenditures as, let's say, an electric utility or a cable company. So therefore, the amount of capital expenditures relative to the total balance sheet is smaller than something that's more capital intensive. So in that case, if you use EBIT, earnings before interest and taxes, it shouldn't be that much different from EBITDA, and you're going to get similar results from your analysis. However, in a capital intensive company, the difference between EBIT and EBITDA might be quite significant, and therefore you have to be more aware of how much the non-cash depreciation and amortization expenses are affecting your profitability and cash flow.
One industry that does have very high capital requirements is oil and gas. And there you often see exploration and production companies essentially plow back all of their operating cash flow into more capital expenditures, essentially. So, what what's the best way to actually value those companies when you have all the operating cash flow used up for capex?
Well, again, like any other business venture, you want to see a return on an investment, whether that investment is in drilling or it's in rights and leases to new properties. The key in those businesses, I believe, you should really make a big distinction between investments in leases and investments in the equipment to extract the valuable oil and gas. And if they're investing in leases, but they're not getting productive wells from them, then that's a problem. That means that those investments are not earning a sufficient return. I think regarding the equipment, that's a different point of view, but the reality should be if I'm investing in leases and in rights to drill, and then I have the cost of that drilling, I should be able to see increased cash flow as those leases turn into productive wells.
And would you say that for oil and gas companies generally, the balance sheet could have a lot of significance, maybe more so than for other companies, because reserves are such an important piece of the value equation?
I think that's true. It depends on what kind of company and what part of the industry they're in. So, for example, if you are a transmission company, a gas pipeline, you have an inventory of reserves. And just like any other inventory, we talked about obsolescence with electronics. You're now part of your investment in this enterprise is the value of that commodity, which may go up or down in value. And it's a question of what percentage of the balance sheet is that inventory. Then you have the reserves, whether it's proven or estimated. And so quite a bit of value. We've talked about income statements and future profitability and cash flow generation as leading to the value of a company. The other side is a balance sheet, what their investments are, how are they valued. And when you have investments, especially in these days, where there's a lot of debt overhanging industry as well as sovereign governments, when people are looking to commodities to keep intrinsic value in hand, that might be the source of real value when you have an extractive industry, minerals or oil and gas.
Could we talk a little bit about how to gauge the financial health of a company by looking at its financial statements? So let's say a company has debt and we might be concerned whether or not they can service that debt. What would be the key items you would look at?
Well, the first metric I look at is debt to equity. I find it interesting that banks generally have 12 to 20 times debt versus equity. It's almost like a reverse pyramid. So what happens is if they lose more than 5% of the value of their assets, their equity is wiped out. And that's the big issue with our banks today because they're undercapitalized, and if they took all their assets and wrote them down, they have no equity. So my training has always said you should have 50% of your capital should be in equity. Debt is good and it has a preference because interest is deductible, whereas dividends are not. But the first thing I look at is debt to equity ratio. The second thing you're looking at is what are the interest rates that you're paying? Given current value of interest rates, you're always looking at what is your after-tax cost for your funds versus the return. If you're earning 10% on an investment and it costs you after tax 2% because you borrowed at 3, that's a good transaction. If your debt is costing you 10 or 15% and you're only earning 7% on that, that's a bad transaction. The third looks more at liquidity. You want to look at when your interest payments are due and when your principal payments are due. And do you have cash flow to cover that? And that's where you're looking at current assets to current liabilities. You're looking at when the debt payments are coming due, and you want to make sure there's enough cash flow to cover that. And that's where you might look at EBITDA or free cash flow, compare it to the amount of principal and interest payments to make sure your interest coverage is there.
Let's talk a little bit about good versus bad liabilities. I think it's an interesting topic because people generally think, well, a liability is a liability and they're all bad. But what about things like deferred revenue or other types of liabilities that can actually signal positive operations for a business?
Well, I love to see accounts payable in the sense that that's a cheap method of financing. If my vendors are allowing me to pay them in 30 or 60 days' time and it doesn't cost me any interest, then that's a very cheap form of financing that I like. I have to have enough capital to make sure the whole business is operational, but to me, if managed well and in proportion to a whole balance sheet, that's a good source of capital. I think that customer deposits, customer advances, they're fine. It's more a question of, is this a sign that we have a backlog of orders and people are giving us money in advance to reserve space with us so that they get products and services down the road? That's wonderful. And again, it's a cheap form of financing. They're advancing us cash in advance. I think what's bad, I'll go back to my earlier response, is when you have too much debt on too thin a capital base, and now you're always being threatened by, if you don't make those principal and interest payments, bad things can happen to the company. Creditors can claim and push you into bankruptcy at the extreme. Whereas if you have the equity and you have the proper mix with debt, then that just increases your profitability, because once you pay back that debt, all the other upside that's generated by your operations flow to the equity holders.
And how would you typically slot something like preferred stock or convertible debt that has features of both equity and debt? How do you kind of take that into consideration?
Well, I think what happens is with preferred stock, what's happening there is you have an obligation, especially if it's cumulative, to pay those shareholders before you can pay common shareholders their dividends. So I look at that as quasi-debt I have to cover that interest in order to flow money to the common shareholders, except it's not a legal obligation. I only have to pay it to the preferred shareholders when the board of directors declares that dividend. Convertible is a little trickier. What you have to do is look at it as it's debt until the owner of the debt decides to convert to equity. And so realistically, they're only going to convert when the value of that equity goes up to a certain point, and they're making more on the equity side than on the debt side. So you, as a company, you have the obligation to pay that interest and to repay that money until the time that they convert. And what you would look at is what's that crossover point when they would be more valuable as equity, and look at what that dilution is.
Now, a while back, there was a big debate around stock option expensing and how to deal with that. What's your view on the real cost of stock options to shareholders?
I have very strong views. I'm glad you've asked this. I believe the way it was treated originally before the changes is fair and appropriate. What happens is when you issue stock options, it's a right but not an obligation for the other person to exercise the option. If it's out of the money, no one will exercise it. When it's in the money, people will exercise it and gain that value. So realistically, the way accounting treatment used to be is you would convert those options that were in the money and issue proportionately how many shares of stock that it would be worth. So if you could convert the shares at $5 a share and today's stock price is 10, you say to yourself, okay, let's assume we're issuing these shares at $5, but today's shares are worth 10. Those new shares, in essence, are being sold at $5. There's a dilution effect, and you show that in your equity section. So you show fully diluted shares based on the dilution effect of exercised in-the-money options. I think that's fair and appropriate. I think the compensation expense is less important, but the reality is it does have dilutive effects, and you should show that. And if you show it on the equity side, rather than worrying about assets and liabilities, it's a fair representation of how the company is valuable to the common shareholders today.
And if you have options that are currently out of the money as they're being granted, then how would you deal with that scenario?
Well, I mean, if I am an investor looking at a company, realistically, based on option theory, it depends on the time value. If they're out of the money and they have 1 day to expire, they're not worth very much because the probability of that price increase and stock price increase is very small. If those are 10-year options, you might say to yourself, based on the beta of the stock, what is the probability that the stock will get into the money at a certain point? So there you may want to look at what the strike price is, the exercise price, and how much time is left on those options. And you might say, I'm going to give it a certain probability, and you say, okay, that probability times how much value it would have, and maybe add some dilution in your analysis of what the true value of the common is.
Got it. And I assume with warrants, it's basically the same type of analysis.
I think options and warrants are calls, and I think you just treat them the same. It's probability that the price is going to rise above a certain point, and you just dilute the equity.
Mm-hmm. Maybe lastly, we could talk a little bit about any kind of items that you would scrutinize, particularly as potential yellow or red flags when you analyze financial statements. And I think initially you did mention, looking at the growth in things like receivables and those kinds of things. What else would you say investors should look at pretty closely?
Well, in addition to traditional ratios and looking at that growth, how the balance sheet should be growing alongside the P&L, how the cash flow statement should be commensurate with the changes in the income statement. I look at, first of all, the audit opinion. Obviously, if it's not a clean, unqualified opinion, you want to look very carefully at that. Number two, you're looking at footnotes, and there it could range to anything of what are litigation, what's going on with intellectual property, what's happening segment by segment in the industry. So even though the total consolidated financials might look good, there are things happening industry by industry. And also you have to look at what's happening to the peer groups and the competition. So I think looking at the numbers is one layer of analysis, and then you have to give a context by the business environment, your peer group in the industry, the countries in which you're participating, especially today. And you have countries that are getting out of businesses, let's say in Greece. They're profitable businesses, but they just have to get out, sell it for a song. I think it was the big retailer, the French retailer, just said they're selling all of their units in Greece. So you have to look at those contextual elements because the world is interconnected, and you have to say how significant is the risk in certain countries, in certain line items and businesses.
And Henry, since you have direct experience by virtue of being chief financial officer of an internet retailer, maybe you could just help us understand a little bit how the accounting differs for online retailers versus brick and mortar retailers.
I think that the biggest advantage I have is that I have very few receivables. When my customers are buying over the internet, 99.9% of the time there's a credit card, and I get my money in 1 or 2 days based on my merchant processor, so I don't have to worry about receivables. Also, with our business model, we often put things up on a retail site for sale. We see how many people are buying, and then we buy afterwards, so we also minimize our inventory exposure. So those are two differences that we have versus bricks and mortar. Third, of course, is property, plant, and equipment. We don't have to have a full retail location and all those attendant investments. So on one hand, we have lower investments in PP&E and lower risk in receivables and inventory. On the other hand, we have to invest in technology that, let's say, a bricks and mortar company doesn't need to technically in order to have their operations. So those would be some of the differences.
And also, shipping is a component of cost. So how do you or other online retailers typically account for that? Let's say you have free shipping above a certain order size. So I assume that eats into your cost of goods, or where does that go?
I think you have shipping obviously is a very big component, and knowing how much the costs will be depends a lot on where your customers are, what the products are, and how they are getting shipped, what mode of transportation. I think the reality is sometimes we build it into the price, even though shipping is free. Sometimes you look at that shipping revenue, and it becomes an art rather than a science to try to get your gross margins accurate, because identifying and segmenting the shipping costs by how the deals get priced is not the easiest thing. Just you often don't have the granularity that you might want on that. But obviously, shipping is a big expense we will have that we won't have in a bricks and mortar operation.
And in terms of returns, would you say online generally they're higher or lower than in bricks and mortar businesses?
My expenses, they're higher. It depends on the product. It depends on your customer base. It depends on the offers and the terms and conditions. I think it's often built in that just as you're going to have to pay for credit card processing, you're going to have to pay for transportation and shipping, you're going to have a certain percentage of returns. And the key is, that if you're running higher than historical, you should investigate that.
Interesting. Henry, you're also a professor at NYU Stern School of Business. You teach a course in financial accounting there. Maybe just as we finish up, could you tell us, are there any interesting topics that you address in that course that we haven't touched on today?
Well, it's a basic introduction to accounting. Some of the people go on to major in accounting and get a CPA, and some of them are pre-med or food majors who want to become chefs, but they want to know a little bit about accounting, either for their businesses or for investments. But one of the things I like to talk about is fraud. Once we have a basic understanding of financial accounting and statements, I do a module on how people have abused financial accounting to their benefit, whether it was Bernie Madoff, ZZZ Best, Enron. There are unfortunately so many that I can't take too many in one class, but I try to show them that if receivables aren't legitimate, if inventory is not real and counted properly, if in Enron's case you have business elements that are off the balance sheet, you could have misleading financial statements, and you should be aware of some of those assumptions. And now that the students are aware, starting with journal entries all the way to a trial balance and financial statements, in how to construct the financial statements, they know where to look, and they use financial analysis and ratios to try to determine where there might be cases of fraud or suspicious activity.
And why do you think it's so hard to detect fraud? You know, when you have all these things to look at, and yet it seems like some frauds just perpetuate for a long time.
Well, let's remember that a clean audit opinion is not a guarantee that there's no fraud going on. So independent auditors are coming in, they're testing transactions, they're testing balances, they're counting inventory, they're sending confirmations to customers, vendors, and banks, and they still may not discover a fraud. So for an investor to do it one step removed is even more challenging. I think the reality is you have to look at management, you have to look at the numbers, look at those consistencies. Is the accrual financial statements showing growth, but the cash flow is showing tightness? So all the growth is in accruals and deferrals. Are things changing materially from what they have been reported recently? Are the trends in this company different than the other companies in that industry? The best you could do is look, investigate your suspicions, and if you feel uncomfortable, you should invest elsewhere, because you just never know what's going on behind the scenes.
Well, on that note, Henry, thank you very much for your time and your insights today.
Thank you very much.